Welcome to this Q4 2025 Market Perspectives video. My name is Andrew Krei. I'm the Co-Chief Investment Officer here at Co Advisors. As always, on behalf of myself and my colleagues, we appreciate you taking a little bit of time to watch these videos. In this one, as a year-end video, we're going to do a little bit of a retrospective as we talk about 2025, what we saw, what we didn't see in some respects, what we expected as a result of some of the tariff-induced volatility ultimately not coming to fruition. So we'll explore some of those themes and the big drivers for market returns, particularly on the equity side in 2025. And then we'll kind of spin that forward and look at some of the big themes, again, from kind of a myth-busting sort of perspective, or at least a little bit of a differentiated point of view. Some of the big topics that people are concerned about as we move into 2026, offering a little bit of a different take, perhaps, on their impact or lack thereof as we move into the new year. So with that, we'll jump right in. So for us, the story in 2025 really goes back to what we saw in the March-April timeframe as it related to the rollout of tariffs, the policy uncertainty that caused, the dramatic dislocation within equity markets, and this thinking that we were really on the cusp of a recession as a result of, again, you're going to see pullback and retrenchment within the corporate sector. You're going to see, cancellation of CapEx plans. You're going to see all sorts of turmoil as it related to, again, this tariff policy, which ultimately started out at a pretty extreme level and then was back down, sort of rolled back, this escalate to de-escalate type of approach that the administration took. But nonetheless, there was a real fear, and I think as we show on the right side of this page on this chart, that corporate earnings were going to be materially impacted by that. And particularly, in the middle part of last year, what we saw was a real decline in earnings expectations for the S&P 500. But then ultimately, as we played that forward and we moved into Q3, Q4, the latter half of the year, we saw a real reacceleration in earnings expectations, not only for 2025, but as we move into 2026 as well. We'll talk more about kind of U.S. versus non-U.S. in a second here, but if we focus on the S&P 500, what you can see is that we really ended the year on a high note. And if you tie that into GDP growth, what we saw was a little bit of a dip, but we're seeing a reacceleration at this point in terms of the forecast for where the economy is going, particularly in the first half of 2026, but a nice continuation of what we saw, a really resilient economy, a resilient corporate sector in 2025 and the back half of the year. So I think, again, kind of what didn't happen so much was important there, that this idea of a recession being sort of manifested as a result of policy uncertainty never came to pass. So that really defined the market in many ways in 2025. Now, as you think about sort of the underpinnings of what we saw within equity markets in 2025 and tie in some of those themes as it related to policy uncertainty, to tariffs certainly, what we saw was a couple different things. One, there was this big concern around, could these mega cap tech leaders, this concentrated portion of the market at the top, the Magnificent Seven as they've been come to be known, could they continue to lead equity markets? And if they experienced any reversion to the mean from a performance perspective, were markets going to be imperiled as a result of that? And what we saw, and what we're illustrating on this page, is that the magnitude of outperformance from that cohort in particular was significantly lower in 2025, and it was really only a couple names that were driving that outperformance. But what we saw was a really, sort of a broadening theme that played out across equity markets last year. And in particular, and as we've been talking about for several quarters, there was an opportunity for a relative value rotation, looking at segments of non-U.S. markets in particular that were offering better starting valuations with a catalyst around their earnings growth expectations. And you look at the fiscal backdrop in Europe, you look at the fiscal backdrop in Japan and China, you look at a weakening dollar, all these sort of elements that influence non-U.S. markets and provide a nice tailwind, considering that alongside their relatively cheaper starting valuations, we finally saw capital flowing into these markets. And as we're showing on the right side of this page, Canada, Europe, UK, emerging markets, those four segments being top performers and outperforming those mega cap tech names. But just broadly speaking, this rotation away from U.S. leadership, U.S. exceptionalism into more non-U.S. markets, that was a real defining feature of 2025, and we think continues to be a theme as we move into 2026. One of the other elements that I think people have been rightly concerned about in many respects, the Fed certainly would be in this camp as well, is the labor market, and looking at potential weakness within the labor market as a sign of perhaps economic weakness on the horizon. And what we would point to is a few different factors here. One is the impact from the immigration backdrop. The administration, they're thinking that they're going to roll back immigration in large part, crack down on immigration, illegal immigration certainly. But you think about the impact that has on the labor market and this idea of kind of the replacement level of jobs that need to be created every month as a function of population growth, and in particular the working age population growth within the United States. And as a function, again, of those policies that have been enacted, what we've seen is that numbers come down materially, right? So if you think about the jobs reports that we were getting perhaps 18, 24 plus months ago, where 150, 200,000 jobs per month would be the norm and kind of the expectation, what we're seeing now is about 50,000 jobs per month is the level that we need as a break-even level, right? Just to sustain unemployment or the aggregate employment rate within the US at its current level. So pretty dramatically different backdrop, but that's more a function of these structural factors as opposed to the idea that the labor market is substantially weakening. On top of that, as we show here on the charts on this page, what we're seeing is really just more evidence that it's a low hiring, low firing type of environment as opposed to outright weakness, let's say, within the labor market. So I think the concerns around the labor market are warranted. I think worth watching as we move into 2026. But from our perspective, it doesn't look like the kind of acute scenario playing out that would really cause meaningful economic deterioration or certainly corporate earnings growth to be hit in some sort of meaningful way. Another key theme that we saw in 2025 as a result of tariffs in particular, but really kind of these lingering themes that were playing out post-COVID, was this idea that inflation was staying stubbornly high and had the potential to reaccelerate even higher because you're going to see flow-throughs of tariffs into prices and really cause this sort of uptick, particularly within goods and all these other elements that were going to be subject to tariffs as a function of the administration's policies. What we saw, and as we show on the left side of this page here, is that yes, there was a little bit of an uptick in tariff-related inflation, particularly within the goods segment of the inflation basket. But as we move into 2026 and we look at the impacts, the projected impacts at least, going forward, we're really through the worst of that. And in fact, it's going to continue to decelerate is the expectation as we move into the new year. So I think the idea, again, that there was going to be some substantial uptick or reacceleration in inflation just doesn't appear to be manifesting itself in the numbers. Alongside that, one of the things we would point to as we move into 2026 is housing, shelter, that component of inflation, which makes up about a third of the basket for CPI in particular. So if you think about a really, really important element of the inflation numbers that you see, those aggregate numbers on a year-over-year basis, is going to be tied to rent, housing, those sorts of things. And what we're seeing, and as we show here on this page on the right side, is that we're seeing rent inflation start to move lower and more real-time measures or indices of rents, on an ongoing basis, have already come down even more, and there's a bit of a lagged effect to the way that the numbers are reported in the index. So we would anticipate that there's going to be more downward pressure on a large portion of the CPI index that will continue to put, again, sort of a cap on inflation, even if we do see a little bit of an uptick elsewhere. Ultimately, that's going to be to the good. So perhaps not down to the 2% level that the Fed wants. That's their target, to hit 2% inflation. But nonetheless, we think this idea that 3-4% inflation levels, again, a meaningful spike or reacceleration is ultimately off the table at this point. The last thing people point to, I think, is a big concern moving into 26, and really even going back to where we were in 2024, 2025, was just really high starting equity valuations, particularly within the US. And we would make a couple comments about that. One is equity valuations are not a good short-term indicator. I think this has been well covered and discussed at length by a lot of market participants, but nonetheless, we think it's evidence, as we point to on the left chart here in 2025, to look at this and say, really last year was a story of earnings growth and dividends. We started at high valuations, we ended at high valuations from at least a historical average perspective. But again, you can have an environment where corporate earnings growth looks pretty good and was resilient, certainly in the face of some volatility, and you can see persistent high valuations in that type of environment. Again, it just doesn't mean a whole lot on a short-term basis. Now, you got to respect it from a longer-term perspective and understand where you're buying in and how that can influence your long-term expected rate of return. But nonetheless, we would point to that and say, high valuations don't necessarily mean that markets can't continue to move higher, and particularly with strong economic and corporate earnings momentum behind them. Now, alongside that, what we would say is perhaps that the analog, in particular, if you look at the dot-com era, which I think a lot of people want to point to today, because there is this sort of buzzy element around what was happening in tech back then, the internet wave, again, the sort of dot-com enthusiasm relative to what we're seeing with AI today and the Magnificent Seven, these large tech names which have been dominating equity market indices, and trying to make the comparison between that era and today's era. And we show you a couple ways of thinking about this just in terms of the lack of a massive acceleration in valuations. We've actually seen relatively flat valuations over the last couple years. But alongside that, just looking at these businesses fundamentally and saying they look much healthier, much higher quality today. And as again, we show, at least from a free cash flow margin perspective, but you could look at this on a couple different dimensions and vectors around profitability, other ways of defining quality, just fundamentally different today than they were back then, or certainly even periods prior to that, right? Just much higher profile businesses, much higher quality and more cash generative businesses today, which all things equal, you probably would pay more for, right, from a valuation perspective. So we think not only are slightly higher valuations perhaps justified in many respects, but we think that it's just not that great of a barometer for investors to use on a short-term basis. So again, we'll be mindful of it. You have to be intellectually flexible and you have to be intellectually honest, but nonetheless, we think that valuation shouldn't be a core concern for investors as we move into the beginning part of 2026. With that, we'll leave it there. Again, I'm Andrew Krei. Thanks for watching.